Assalamualaikum warahmatullahi wabarakatuh. Good afternoon, my friends and honorable lecturer. My name is Rana Shiva Medinda. On this occasion, my friend and I would like to present to you about insurance contract based on DE PSAK 74. DE PSAK 74 insurance contract or Statement of Financial Accounting Standards 74 insurance contract establishes principles for the recognition, measurement, presentation, and disclosure insurance contract. The purpose of DE PSAK 74 to ensure that entities provide information relevant documents that accurately represent the contract. The information provides a basis for user of financial statement to assess impact of insurance contract to the financial position, financial performance, and cash flows of entities. Next, scope of DE PSAK 74. Entities apply DE PSAK 74 insurance contract for insurance contracts include reinsurance contract that issued by the entities, reinsurance contract provided, and investment contracts with discretionary participation features that issued by the entities as long as the entities issued insurance contract. Combination of insurance contracts. A group or series of insurance contracts with the same or the counterparty that are related to can achieve or are designed to achieve an overall commercial impact. To reporting the substance of contract, entities might need to treat set or series of contract as a whole. If right or obligation in a contract, it doesn't work anything except negate right or obligation in other contract that agreed in the same time with the same counterparty. So the effect of combination not create right or obligation. Separation of components from the insurance contract. An insurance contract may consist of one or more of the included components within the scope of other statement if the components are separated in the different contract. The example insurance contract that includes an investment component or service component or both. Aggregation level of insurance contract. Entities identified portfolio of insurance contract. Portfolio consists of contract that has some risk and managed together. Contract in one product line are expected has some risk and thus are expected in the same portfolio if the contract is managed together. The entity divides the issue insurance contract portfolio into first a group of contracts that losses are onerous at initial recognition. Second, a group of contracts which at initial recognition has no significant possibility becomes losing contract, and last a group of contracts remaining in the portfolio. Recognition. An entity shall recognize a group of issued insurance contracts at the earliest of the following options. First, the beginning of the coverage period of the group of contracts. Second, the date when the first payment from one policyholder in the group was due. And then, when the group becomes lost for the contract group that loses. If there is no contractual maturity date, the first payment from policyholder is deemed due when the payment is received. Entities recognize assets or liability for insurance cash flows relating to a group of issued insurance contracts where entities pay or receive cash flows before the group of contract is recognized, except entities choose to recognize the cash flow as expense or income. When recognize group of insurance contract in a reporting period, entities can only enter the issued contract until the end of reporting period and make an estimate for discount rate at the initial recognition date. Measurement. Measurement at initial recognition. At initial recognition, an entity measures the group insurance contract at total value of first fulfillment cash flows and second the contractual service margin. And fulfillment cash flows includes estimates of future cash flows, then adjustments to reflect the time value of money and financial risks related to future cash flows, as long as the financial risks not included in estimates of future cash flows, unless adjustments for non-financial risks. Estimates of future cash flows. In the measurement of a group of insurance contracts, the entity includes the whole of future cash flows covered by the limits of each contract in the group. The estimates of future cash flows are first include all reasonable and supportable information that available with free of charge or excessive effort with an unbiased manner regarding the amount, time, and uncertainty of future cash flows. Next, reflect the entity's perspective. As long as the estimation of any market variable that consistent relevant with the market price that can observe the variables. Then current. The estimate reflects condition that exist at the measurement that including assumption at that about the future. And last, explicit. The entity estimates adjustment for non-financial risks in an explicit manner separate from other estimates. The entity also estimates cash flow separately from adjustment of time value of money and financial risk. Discount rate. An entity shall adjust the estimated future cash flows to reflect the time value of money and financial risk associated with these cash flows, as long as the financial risk not included in the initial estimates of cash flows. The discount rate, which used for estimate the future cash flows, first reflects the time value of money, cash flows characteristics, and liquidity characteristic of insurance contract. Then consistent with current observable market price, if any. For the financial instrument with cash flow, whose characteristics are accordance with the insurance contract. And last, excludes the impact of factors affecting the market price or price of observable market, but does not affect future cash flows from the insurance contract. Adjustment for non-financial risks. The entity adjusts the estimated current value of future cash flows to reflect the compensation that the entity needs to bear the uncertainty of amount and time of cash flows that arising from non-financial risk. The contractual service margin. Contractual service margin is a component of assets and liabilities for a group of insurance contracts that reflect unearned profit that will be recognized when the entities provides the service in the future. The entity measures the margin for contractual service at initial recognition of a group of insurance contracts for an amount that does not arise an income or expense from a initial recognition of the fulfillment cash flow amount. B. The recognition at the date of initial recognition of the assets or liability recognized for cash flow acquisition insurance. Last, any cash flows arising from the contract are classified as the date of recognition. Further measurement. The carrying amount of a group of insurance contracts at the end of each period reporting is the sum of first, liabilities for the remaining insurance period. Second, liabilities for claim events. And liabilities for the remaining insurance period consist of cash flow fulfillment relating to future services that allocated to the group at the reporting date. Then contractual service margin for the group at the reporting date. Contractual service margin at the end of reporting period represent the profit of insurance contract of group that are still not recognized in profit or loss because regarding of future services that must still given by the entities under the contract in the group. And liabilities for claim events consist of fulfillment cash flows related to past services that allocated to the group at the reporting period. Insurance contract. An insurance contract is said to be lost at the initial recognition date if cash flows fulfillment allocated to the contract, the acquisition cash flows that have been previously recognized, and cash flows arising from the contract at the initial recognition date overall resulting in a net outflow. An entity recognizes the loss and profit or loss for net outflows that results by losing group of contract make the amount of recorded liabilities for the group equal with fulfillment cash flows, and the contractual service margin of the group becomes zero. Losses on further measurement if the following amounts exceed the carrying amount of the contractual service margin: an unfavorable change in the value of the fulfillment cash flows allocated to the group, where the change arises from the change in the estimated future cash flows related with future services. And then the entity's share of the top impairment in the fair value of the base item. Premium allocation approach. An entity can simplify the measurement group of insurance contract by using premium allocation approach. The coverage period for each contract in the group is 1 year or less than 1 year. In applying the premium allocation approach, an entity first may choose to recognize the cash flows of the insurance acquisition as an expense when issued as cost, and then measures the liability for the incidence of claims for a group of insurance contract. Reinsurance contract provided. Recognition. If the reinsurance contract provides coverage that is proportional at the beginning of coverage period of the reinsurance contract provided or at initial recognition underlying contract, whichever is later. Then, in other cases, from the beginning of coverage period of the group reinsurance contract provided. Next, measurement. The entity used consistent assumptions to measure the estimate of the current value of the future cash flows for reinsurance contract provided, and estimates of the current value of future cash flows for the baseline group of insurance contract. For the estimation of current value of the future cash flows for the group of reinsurance contract provided, entities include the impact of any non-performance risk by the issuer of the reinsurance contract. The premium allocation approach for reinsurance contract provided. An entity can use the premium allocation approach to simplify the measurement of a group of reinsurance contract provided if the entity reasonably expects the resulting measurements to be no different material. Then, the coverage period of each contract in the group of reinsurance contract provided is 1 year or less. Investment contract with discretionary participation feature. Requirement in the PSAK 74 contract insurance for insurance contract is customized for investment contract with the discretionary participation feature as follows. First, the date of initial recognition is the date on which the entity is a party in the contract. Second, the contract limits are adjusted so that the cash flows are within the limits contracts. If the result is from the entity substanti's obligation to hand over cash in this time or in the future. Last, the allocation of the contractual services margin is modified so the entity recognizes a contractual service margin over the duration of the group contract with systematic manner that reflects the transfer of investment services under the contract.
Good afternoon, my friends and my lecturer. In this lovely afternoon, I would like to continue the explanations. But firstly, I would like to introduce myself. My name is Dwi Rahmadani Davis. You can call me Dini. So, let us continue the explanation. Modifications of insurance contract. Based on draft exposure PSAK number 74, state that a contract that qualifies as an insurance contract remains an insurance contract until all rights and obligations are extinguished. An obligation is extinguished when it has expired or has been discharged or cancelled. However, in some cases, an entity may modify the terms of an existing contract in a way that would have significantly changed the accounting of the contract if the new term had always existed. In some cases, insurance contract modifications will result in the recognizing the insurance contract. A modification of an insurance contract amends the original terms and contracts of the contract. For example, extending or shortening the coverage period or increasing the benefits in return for higher premiums. It differs from a change arising from a party to the contract exercising a right that is part of the original terms and condition of the contract. So, if the condition of the contract is met, the contract is modified in a way that would have significantly changed the accounting of the contract had the new terms always exist. So, as you can see, this is several conditions of modification of the contract that must be met if the entity wants to modify the contract. We can see that draft exposure number 74 requires an entity to recognize an insurance contract liability from its statement of financial positions only when it is extinguished or modified. An insurance contract is extinguished when the obligation specified in the insurance contract expired or is discharged or cancelled. But maybe an entity might not know whether liability has been extinguished because claims are sometimes reported years after the end of the coverage period. It also considered concern that an entity might be unable to recognize this liability. Because of that, there are several terms of the recognitions that must be fulfilled by the entity if they want to recognize the insurance contract. So the first is the fulfillment cash flow allocated to the group or adjusted to eliminate the present value of future cash flows and adjustment for non-financial risks related to rights and obligations that have been recognized from the group. It means that the fulfillment cash flows are the current estimates of the amounts that an insurer expects to collect from premium and payout for claims, benefits, and also expense, adjusted to reflect the timing and the uncertainty in the amounts. The adjustment for uncertainty is called the risk adjustment. The cash flow of a group of contract may be affected by the cash flow of other group of contract as specified in the terms of the contracts. And second is the group contractual service margin is adjusted for changes in fulfillment cash flow described in point 1. As we know that the contractual service margin represents the profit that the company expects to earn as it provides insurance coverage. This profit is recognized in profit or loss over the coverage period as the company provides the assurance coverage. At initial recognition of the contract, the contractual service margin is the present value of risk-adjusted future cash flows less the present value of risk-adjusted future cash outflows. And the last is the number of unit of coverage for estimating remaining coverage period is adjusted to reflect the unit of coverage recognized from the group. And the next is presentations on the statement of financial positions. An entity shall present separately in the statement of financial positions the carrying amount of following groups. There are consists of insurance contract issued that are an asset, second, insurance contract issued that are a liability, third, a reinsurance contract held that are an asset, and fourth, a reinsurance contract held that are a liability. And also, an entity shall include an asset or a liability to the cash flow of an insurance acquisition recognized to insurance contract, and the assets or liability to the related group reinsurance contract cash flow in the carrying amount reinsurance contract group. So it means that based on draft exposure PSAK number 74, that specifies requirements for the recognitions, measurements, and presentation and disclosure of group of insurance contract. Those requirements reflect all the rights and obligations that arising from the group of insurance contract as a single asset or liability. Based on this standard, that requires entity to present groups of contract that are in an asset position separately from group of contract in a liability positions in the statement of financial position. This requirement results in the need for an entity to allocate premium cash flow and the liability for incurred claims to each group of insurance contract to determine if that group of insurance contract is an asset or liability position. The next is recognition and presentation on the statement of financial positions. We know that, and based on the explanation before, we know that an entity separate the amounts recognized in the statement of profit or loss and other comprehensive income into first, insurance service proceeds that consists of insurance revenue and insurance service expense, and also second, insurance income or finance expense. So firstly, we must know what is the difference between insurance revenue, insurance service expense, and also the insurance finance income or expense. So let's we see for insurance revenue. Insurance revenue is the revenue from insurance contract that represent the considerations that the company expect to be entitled to the exchange for service provided under the contract. It includes the consideration that covers the amount of contractual service margin recognized in profit or loss for the period and the amount of insurance expense incurred in the period. Many insurance contracts with investment features include in a deposit component. In example, amount paid by the policyholder that is repaid by the insurer even if an insurer does not occur. So deposit components are excluded from profit or loss. In example, the collections of deposit is not revenue and the repayment of the deposit is not an expense. Meanwhile, the insurance expense is the service. The insurance expense reflect the cost incurred in providing service in the period, including incurred claim and exclude the repayment of deposit components. And then the insurance finance income or expense based on draft exposure PSAK number 74 requires a company to account for the fulfillment cash flows and the contractual service margin on a discounted basis that reflect the timing of cash flow. As the time passes, the effect of time value of money reduces, and this reduction is reflected in the statement of comprehensive income as an insurance finance expense. In effect, the insurance finance expense are akin to interest paid on advance payment and reflect the fact that policyholders typically pay premiums upfront and receive benefits only later of the debt. And then an entity shall present income or expense from the reinsurance contract separately from the expense or income from the issued insurance contract. Um, in draft exposure, PSAK number 74 applies to reinsurance contract held by an entity. An example, in which the entity is the policyholder, it requires a reinsurance contract held to be accounted for separately from the underlying insurance contract to which it relates. This is because an entity that holds a reinsurance contract does not normally have a right to reduce the amount it owes to the underlying policyholder by amount it expects to receive from the reinsurer. But that separate accounting for the reinsurance contract and the underlying insurance contract might create mismatch that some regard as purely accounting. For example, on the timing of recognition, the measurement of the area insurance contract and the recognition of profit. But however, the board conclude that accounting for a reinsurance contract held separately from the underlying insurance contract um, give a faithful representations on the entity's right and obligations and also the related income and expense from both of the contract. Next is insurance income or insurance expense. And now we are going to continue discussion about insurance finance income and expense. Based on explanation before, we know that entity describe the relationship between insurance financial income or expense and the return on investment in its assets to enable users of financial statement to evaluate the sources of financial income or expense recognized in profit or loss and other comprehensive income. So it means that um, insurance finance income or expense are expected to have significant effect on the performance of an insurer, particularly if it is issues long duration contract. Based on draft exposure pass account number 74 that allows an entity to choose how to present insurance finance income or expense. Therefore, um, it is important for entity to disclose some informations about first for contract with direct participation features that allows entity to choose how to recognize changes in the effect of financial risk. If the entity use the derivative to mitigate the financial risk, such changes may be recognized either in profit or loss or by adjusting the contractual service margin. But if the contract with direct participation feature, if any entity choose not to adjust the contractual service margin for some of the changes in cash flow fulfillment, it means that for contract with direct participation feature, an entity choosing to disaggregate insurance finance income or expense between the profit or loss and other comprehensive income might be changed the basis on which it determines the amount to be included in profit or loss from systematic allocations to the current period book year. So and also contract with a direct participation feature if an entity changes the basis for the separation of insurance income or expense between profit or loss and other comprehensive income, the entity shall disclose in the period in which the changes in approach appears. The first is the reason why the entity is required to change the basis for the separation. So the entity must disclose why what is the reason that make them changes the basis for the aspirations. And the second, the amount of the adjustment for each item in the financial statement that is affected. So the entity also determine what is the amount that can be adjusted for each item in the financial position that give the effect to the insurance finance income and expense. Uh, and the last is the carrying number of insurance contract affected at the date of changes. Next, we are gonna discuss about disclosure. of insurance contract. But firstly, we must to know what does it mean by disclosure and what is the purpose of this disclosure. So the purpose of the disclosure requirements is for an entity to disclose information in the notes to financial statement, which together with the information in the financial statement of financial positions, financial performance report, and cash flow statement, provide a basis for users of financial statement to assess the impact that insurance contract have on the statement of financial positions and financial performance and the entity's cash flows. In other words, an entity should disclose information that give a basis for users of financial statement to assess the effect that contract within the scope of draft exposure number PSAK number 74 that have on the entity's financial positions effect. And also the financial performance, an entity should disclose the informations that give a basis for users of financial statement to assess the effect that contract within the scope of draft exposure number 74 PSAK number 74 have on the entity's financial positions for the financial performance of the entity. Number of transitions. An entity shall disclose a reconciliations of the contractual service margin and the insurance revenue amount separately for first, an insurance contract that exists at the transition date for which the entity adopt a modified retrospective approach. It means that by adopt a modified retrospective approach, permit an entity to determine insurance finance income and expense, include in profit or loss using the discount rate at the transitions that if an entity choose to disaggregate insurance finance income or expense into an amount include in profit or loss and an amount include in other comprehensive income. So in addition, the modification provide an expedient for determining the amount of the accumulated balance in equity relating to insurance finance income and expense. Second, an insurance contract that exists at the transition date for which the entity applies the fair value approach. So it means that the fair value approach also permits the same modification as the modified retrospective approach relating to first assessment relating to assessment about insurance contract or groups of insurance contract that would be made at the date of inceptions or initial recognitions, and also determining the discount rate and the effect of changes in discount rate necessary to determine nature and level of risk arising from contract within the scope of draft exposure PSAK number 74 about insurance contract. The disclosure about insurance and financial risks arising from insurance contract are similar to the disclosure about financial risks arising from financial instrument. This include a sensitivity analysis for insurance risk and for each type of market risk, together with disclose about exposure to risk and how they are arise, objective policies and process for managing risk and the method used to measure this risk, and also concentration of risk arising from insurance contract, the claims development, in example, actual claims compared with previous estimate of the undiscounted amount of the claims, the credit quality of the insurance contract assets, and liquidity risk, and also including a maturity analysis showing the estimated cash flow arising from insurance contract. And also, draft exposure PSAK number 74 also requires a company that issues insurance contract to disclose information about the effect of the regulatory framework in which it operates. For example, such information might include minimum capital requirement or required interest guarantee. The next is case of insurance contract. So we took an example of PT Asuransi Jiwasraya. So we analyzed that PT Asuransi Jiwasraya already determined the income recognitions, expense recognitions, and also other informations. So let us we look to income recognitions by PT Asuransi Jiwasraya. So in the process of recording all economic events, PT Asuransi Jiwasraya Jambi refers to the Statement of Financial Position Standard, PSAK number 36. Thus, the process of recording revenue and at PT Asuransi Jiwasraya is recorded based on the accrual basis method. So, of course, we know that what is the accrual basis method, which is the process of recording accounting transactions, where the transaction is recorded when it occurs, even though it has not received or issued cash. The main sources of income at PT Asuransi Jiwasraya consist of premium income, and premium income is divided into two. There are gross premium income and other income. And for the expense recognitions, the process of recording expense is recorded based on the accrual basis too, which is the process of according accounting transactions where the transactions are recorded when they occur, even though they have not received or distributed any cash, which is the directly enter into the company computer. Insurance expense at PT Asuransi Jiwasraya divided into two types. There are claim expense, which consists of gross claims or claims and benefits, and also operating expense, which consists of marketing expense, general expense, and non-operating expense. So this is some cases of insurance contract by PT Asuransi Jiwasraya. The first is recognition and measurement of liabilities. Liabilities contained in the balance sheet of PT Asuransi Jiwasraya Jambi only other liabilities. Generally, we know that the liability in this life insurance company are the liabilities of the life insurance company to the policyholder, which include future policy benefits liability, reserve for unearned premiums, estimated claims liability, claims payable, and liability to unlinked holders. But, however, PT Asuransi Jiwasraya Jambi does not record and calculate the liability for future policy benefits in their financial statement. Therefore, the liability for future policy benefits that occurs is only made at PT Asuransi Jiwasraya head office to be calculated and estimated. The result of this calculation and estimated made by the head office are then sent back by the branch office, but only in the form of information, so they are not reported in the annual financial report of PT Asuransi Jiwasraya Jambi, but reported as a whole by PT Asuransi Jiwasraya head office in their annual financial report. And also the disclosure. PT Asuransi Jiwasraya Jambi does not make notes on financial report but is carried out by the head office. As a result, there is no accounting policy. However, PT Asuransi Jiwasraya Jambi disclosed matter regarding life insurance contract in the annual report, which shows that the company's financial position, whether it is disclosed in the balance sheets or the income statement. So there is the case that faced by the Asuransi Jiwasraya in their